Hello, welcome everyone to this presentation on installment payment of income tax, year of assessment 21-22. Now, your first installment payment is due on August 15, 2021. Perhaps you would have received your self-assessment advice from your tax advisors. So, but why we thought of doing this kind of a presentation to the corporates is mainly because of one important factor that during last couple of years, especially last 1.5 years, 2 years time, there were so many changes in the country, in the world, because your business environment, there are so many changes, so many challenges, and your business models would have changed. Actually, there are changes, and also the regulatory framework, including tax framework. There were so many changes, especially that are introduced by the new government. So basically, everything have been changed. So therefore, your estimation has to be carefully, consciously tackled. Otherwise, blind computation or estimation of the first installment payment results in overpayment of taxes. In this difficult situation, making an overpayment is not advisable from the perspective of corporates and the perspective of the shareholders. So, as I mentioned a little while ago, maybe you would have received the self-assessment advice from your tax consultant. But you may be wondering, you may be thinking as to when it has to be settled, as to how it has to be settled. The funding part. Of course, it is due on or before 15th of August, coming 15th. Of course, August 15th, this month. So, but your liability, how it has been calculated, what factors has been considered. I mean, maybe for a CFO, maybe for a CEO even, maybe for a finance manager, you need to know how it has been calculated, because it matters, because you make a cash payment to the government. Before that, you need to know the basis of calculation, how and how it has been calculated. So this presentation will guide you, will give you some glimpses of revisiting the areas that are of vital importance, so that I will take you through this presentation for the benefit of corporates. So how do you calculate your quarterly installment payment? Act provides you a simple formula, that is A minus C divided by B. A is your estimated tax liability for the current financial year, the year of assessment, that is 21-22. C is your credits, tax credits, that is previous installment payments, as well as withholding tax credits as at the date of the payment. But divide by the remaining number of installments. Now, in this case, most of the withholding provisions were abolished, removed. So therefore, basically, in majority of the cases, there won't be withholding taxes in the case of tax computations of resident companies, corporates. And apart from that, you deduct F. What is F? F stands for, that is actually not given in the Act, but I have incorporated F, that is the other credits such as economic service charge, notional tax credits, right? Carry forward balances. Then let's take an example. Let's say you estimate a liability of 40 million for the current year of assessment, 21-22, 40 million. For the simplicity, let's assume you don't have any withholding tax credits. In fact, it's very low, as I mentioned. And that divided by remaining number of installment is 4. And again, let's assume you don't have any brought forward ESC credits or brought forward what you call notional tax credits. So that is again 0. So therefore, the 40 million divided by 4 is 10 million. That is your installment payment. That's a very straightforward calculation. But what is important here is A, estimated income tax payable for the year of assessment 21-22. How do you compute that? That is the core importance, core focus of this presentation. So the estimated tax payable is calculated by, here you have your tax estimated taxable income into the tax rate. Yeah, right? Here the tax rate again is important. You know, there were certain list of amendments to the first schedule where you have now so many tax rates. Even within one particular organization, you can have multiple tax rates, not like in previous regime up to 31st March, 31st December 2020. Now, even one single company can have different rates. So therefore, be conscious of that, apply the applicable and correct tax rate to your organization. And the remainder, that is estimated taxable income. How do you compute the estimated taxable income? How? Let's see. As per the Inland Revenue Act, you have 4 sources in employment, business, investment, other sources from where you deduct qualifying payments and relief. Now, for a company, you don't have employment income. You have business income and investment income, and very remotely you will have other source of income. But let's focus on business income because that is the most dynamic area of your calculation. So that is how you calculate your estimated taxable income. Fine, okay. Then how do you compute your assessable income from business? Let's see. So you estimate your accounting profit and then you convert estimated accounting profit into estimated assessable income from business. The difference between these two are the provisions in the Inland Revenue Act. You see, there are certain allowable expenses, there are certain disallowable expenses, certain additional deductions, certain exemptions. So therefore, you have to convert your tax estimated accounting profit into estimated assessable income from business. This part, of course, certainly you can, yourself or your tax consultant will do. Right? They are better off in identifying these adjustments. But what is again estimated accounting profit? How do you compute it? In the Inland Revenue Act, you can't find any specific guideline which gives you the basis of computing the estimated accounting profit. But in fact, it has to be a logical approach. You can't arbitrarily assume that I'm going to make a loss in this year and I'm going to make a profit in this year, so much. But it has to be a rationalized basis. It has to be a logical basis. So being accountants, we know how to estimate. We know how to estimate profits of an organization. But I have to emphasize one more item here. The estimation, you would have heard about estimate, you would have heard about budget, and you would have heard about forecast. Now these things, these three things appear to be the same, but it is not the case. Budget is something else, the forecast is something else, estimate is something else. There is a slight difference. So you have to identify and estimate your accounting profit, first of all. So how do you estimate your accounting profit? Of course, it is your P&L of the forthcoming year. But how do you estimate it? Yeah, you can estimate line by line. Revenue, cost of sales, gross profit, admin, marketing, finance cost. Thereafter, you will arrive at your profit before tax. Maybe maybe you can primarily based on your previous financial statement. But as I mentioned at the outset, this is a very specific time period we are going through. Therefore, incremental budgeting, incremental estimates will not help you in each and every component. So therefore, you have to focus on two broad areas. That is internal aspects as well as external aspects. What are internal aspects? What activities you have planned for the current year? Expansions, new business, expansion into new geographical areas, new products, right? So how much you are expecting to increase in terms of revenue? How much cost will that involve? Right? Certainly, when you increase your revenue, your cost of sale will go up, your admin cost will go up, and how much it requires for research and development, how much it requires for additional staff, how much it requires for marketing. Right? If you are going outside the country, how much it requires for different activities outside the country, and how much it requires, how much of loans you need for the investment, how much of expenses will it attract. And also mainly in most of the estimates, we have seen that corporates are mainly relying on the income statement, but whereas we emphasize the most important area is the balance sheet. That is the foundation of your income statement, which reflects the fruits of the tree, that is the balance sheet. So the investment in non-current assets, it will attract, it will give you sometimes enhanced capital allowances. Current assets, how much you need to invest in inventories, how much you need to invest in debtors, likewise, and loans, as I mentioned. So it's a combined activity based on real scenarios. What activities you have planned? Are you going on the same line of activities, or are you trying to move, expand? Have you planned? Are you planning to do your business in a different way? All that matters. And that is internal factors. And what about external factors? What impact the exchange rate will give to your business? What impact the interest rate can give to your business? Technological factors. Competitors are coming in. Maybe they may be doing their business virtually. You may be doing your business manually, physically. So what impact it brings? So will there be any restrictions on your business in the forthcoming period? Will there be any encouragements on your business? Will there be further restrictions on imports? Will there be further restrictions on dollar payments? Are you facing a dollar crisis? Right? So all internal as well as external factors you need to incorporate into your estimate. Otherwise, it surely at the end of the period, either you will end up with the excess payment of tax or significant underpayment of tax. And in this scenario, I would say the things are not going well. So you will end up with an excess payment, which is not advisable from the point of the investors. Right. Now we estimated accounting profit. How do you estimate your tax profit? That's a conversion. That is the conversion we discussed at the outset. What adjustments you need to do? Adjustments like certain income items are exempted, foreign income, overseas, foreign sources, those are exempted. And agriculture business, those are exempted. So you can eliminate those from your profits. And also there are different entitlements, deductions, like, enhanced capital allowances. If you're going for a new business, you will be given enhanced capital allowances under 6th or 4th schedule. And also you will be given double deductions on research and development expenses, marketing expenses. What marketing expenses you can claim, whether you are entitled to claim capital expenses. What marketing expenses will be entitled for double deduction? How much you can claim? Of course, marketing expenses, you can go up to 500 million. So if you spend 500 million, you will be given 1 billion deduction as being marketing expenses. So likewise, you need to convert your accounting profit into tax profit. Then you end up with the estimated tax profit. Then you know, after this process of analyzing, then you know what is your estimated taxable income. And then you are certain about the tax rate applicable to your organization. Then you are certain about estimated tax payable. But this process of analysis has the potential of giving reductions to your tax estimated tax liability, or rather estimated profit, whereby the reduction in the tax liability, because your analysis was was actually a logical approach, not an arbitrary estimation of the things, because arbitrary estimations is not logical and can, even the Inland Revenue Department can challenge your estimation. So therefore, before making your first installment payment, make a proper estimate and make a proper estimation of your tax liability and make it on or before the due date. Therefore, you will have a better understanding of your tax liability and the forthcoming year, and you will end up with your year without making any excess tax payments to the government. So I think this presentation has given you certain thoughts to think of and develop your internal controls, your analysis, and your thoughts on that. So therefore, thank you very much for listening. I thank everyone on behalf of Dasanaika Associates. So have a great time, stay safe and stay blessed. Thank you.